Good afternoon, and welcome to Nature's Returns, Investing in Ecosystem Services, a webinar series hosted by the Yale Center for Business and the Environment. My name is Corey Scalt, and I will be your host for today's presentation. As many of you know, the Nature's Returns webinar series addresses the growing importance of ecosystem service valuation and investment. Each presentation is recorded and available from CBay through YouTube and on the Yale iTunes U channel. Today, we are talking about environmental impact bonds, how exactly they work, and what lessons have been learned through an expert's experience with designing and implementing them. That expert is Eric Letsinger, our guest today and the founder and CEO of Quantified Ventures, a for-profit impact investing firm that helps clients finance specific and measurable environmental, health, and educational outcomes. Eric is a tri-sector executive with over 25 years of leadership experience in government, nonprofit, and private sector organizations operating in healthcare, environment, education, and housing. He has led transformative public-private initiatives to drive social impact in complex cross-sector business environments, including IBM, Baltimore Public Schools, Baltimore Housing Department, Cyvalent Software, PwC, and Samaritan Inns Homeless Services. Eric has an MBA from Yale University and a BA in Urban Studies from Northwestern University. Over the next half hour, Eric will discuss Quantified Ventures DC Water project and dive into lessons learned from his experiences. He will also discuss how to scale the impact bond model, touching on the use cases of urban wood reclamation, agricultural best management practices, and coastal wetland restoration. Now, before we get started, I'd like to remind our listeners that there will be about 15 minutes for Q&A at the end of the session. We encourage questions, and you can type yours in the Q&A section of your screen throughout the presentation. We will collect them, and I'll present them to Eric at the end of the program. So, all right, let's get started. Eric?
Terrific. Thanks, Corey. Pleasure to be with everybody today. Looking forward to a good conversation. Today we're going to talk about scaling environmental impact bonds. And before we jump into that, let me even just preface it with the fact that these are brand new. We're just getting started. We've got a lot of these transactions underway, and we're learning every day how to be better, smarter, cheaper, and faster as we structure these things. So looking forward to learning with all of you today. Let's go to the agenda slide and just talk through what we're going to try to accomplish here. We'll talk a little bit about us at Quantified Ventures and who we are. We'll talk about the DC Water Environmental Impact Bond, which is our first transaction up on the board, fully closed. And then we'll switch to just sharing some of our lessons learned. That was a tough transaction to get done. It didn't end the way we thought it would when we started it, and we've got a lot of lessons to share with others who are leaning into this field. And then we're going to talk about just some different use cases that we've gotten underway. It's been an interesting process since that transaction closed. We've had a lot of partners from across the field engage with Quantified Ventures to consider whether we could shoehorn different issues across the environmental and infrastructure realm into the environmental impact bond model. And some of those we've been successful with, and some of those we are not pursuing. But I want to share a handful of the ones that are currently under construction, just so we can start to begin to paint the picture of where we're headed with these with this model. All right, let's jump into who Quantified Ventures is on the next slide there. At the end of the day, we are working with a lot of partners in this field. And again, when the DC Water transaction closed in September of last year, it opened up a pretty rich dialogue now that there was a transaction up on the board to begin to think about how we can apply it in different areas. The DC Water transaction itself was designed to better manage stormwater by way of green infrastructure, But as everybody can see from this slide, we've got a very active list of partners that we are working with to take this model into new, different, and exciting use cases across the environmental and infrastructure fields. So rah, rah for our awesome partners here. Okay, let's head on to the next slide. So we do these transactions. By these transactions, I mean we do outcome-based transactions across the healthcare sector, the environmental sector, and the education and workforce development sector. And just to normalize our language a little bit, everybody calls these things something else. You'll hear pay for success. You'll hear social impact bonds. You'll hear environmental impact bonds, and you'll hear impact bonds. The thread through all of those titles is just the mere notion of tying funding to the outcomes that the project is intended to produce. So instead of merely funding a project or a program and then hoping for the best and get a quarterly newsletter on the update, you're actually tying that initial funding to whether that program or intervention actually produced the outcomes that it was intended to produce. So for today, we'll talk about the DC Water project, which was a pay for success project, a social impact bond project. It was the first one in the environmental space, so we're not marketing people, so we called it an environmental impact bond. That's the best we can come up with. Just a quick snapshot of that transaction, and then we will jump into the model and how DC Water actually worked. We were the transaction structurer for that transaction. It was the largest pay for success project in the United States, which was exciting. I think one of the big pokes in the eye that social impact bonds and pay for success gets, and well deserved, is that the transaction costs tend to be quite high. And this transaction had the lowest transaction costs of any social impact bond done in the United States. And not only was it about 10 times cheaper than the next cheapest social impact bond to get done, it actually was about 35% cheaper than floating a municipal bond, which is the other way that DC Water and Sewer Authority would have financed this project. So that was an exciting threshold to cross. The other thing is it was a highly customizable financial structure. This was the first social impact bond that was actually a bond. It was a municipal bond, so it used all the basic tenets of that financial instrument. And as a result, however, the payback mechanism to those who bought the bond is driven by the performance of the actual project. In this case, it was green infrastructure. The investors were Goldman Sachs and the Calvert Foundation. At the end of the day, they bought those bonds because they're betting on the fact that green infrastructure will work as predicted. All right, let's move on to the next slide here, and we'll talk briefly about just the model, the pay for success model or the environmental impact bond model. How does this work? Let's talk about the investors first at the top of the model. And let's talk about where that capital comes from, because it's new and it's weird and it's enabling this model to actually have legs in this country. So we're in the middle of the largest wealth transfer in the history of the planet. And as we have baby boomers with wealth, who were comfortable in an environment where they worked hard for their money over here, and then over there they gave away money to their favorite charity, and that dual life worked for them. As they are passing their wealth down to their Gen X and millennial children, the wealth now being in the hands of those two generations more and more, as that tsunami of wealth transfer is happening. Those two generations have wildly different views as to how they want to see their wealth deployed. And they are more inclined to want to invest their wealth in social, health, or environmental challenges or projects. But they want a financial return, meaning in droves, they're less enamored with the outcomes associated with giving your money away or giving their money away. And they're more enamored with investing their money, seeking a financial return, and they may or may not be okay with a lower return, but in exchange for that, they want rigorously validated, rigorously evaluated, and measured outcomes. So they're less inclined to want to get that quarterly newsletter from the charity saying, hey, things are going pretty good over here. And they're more inclined to want to see very rigorous evaluation results to demonstrate whether outcomes are being produced. So that's the source of the capital. That capital is spread through impact funds, ranging from again, I'll just use the investors for DC Water, was Calvert Foundation, 501c3, impact investing shop that's aggregating this type of money that we were just talking about, all the way to Goldman Sachs. They have their fund where they're aggregating their high net worth funds to deploy in the types of transactions that we're discussing here today. That kind of capital is plentiful. And that's what enables this engine to sort of move forward. So the way the model works is we look for a service provider. That's the agent down there in the bottom right. The service provider does something, right? And in this case, it was for the DC Water transaction, it was an engineering firm that can implement green infrastructure. Service providers can be nonprofit organizations. We have transactions in the healthcare sector with Meals on Wheels as the service provider. It can be for-profit, nonprofit. We have a service provider transaction that we're scaling with a Fortune 200 company. All to say, we're indifferent as to the legal structure of the service provider. All we're interested in is the evidence that undergirds the efficacy of their intervention that we're trying to scale. And that service provider does something, some project, some program, some set of interventions that intentionally or inadvertently saves that public entity on the left money, right? So if they're as a result of the service provider doing what they are doing, the public entity, whether that's a health plan or a hospital system or a government agency at the local or county or state level, as a result of what that service provider does, that public entity actually makes money or saves money or values those outcomes in some way. And then in theory, if we were to scale up that service provider's work, then we would, then that public entity would save more money or make more money or enjoy a higher quantity of the outcomes that are generated. And so when that public entity actually saves that money or makes that money, and it's validated by that player in the middle, the evaluator, then out of those savings or increased revenue, they then pay back the investor. That, at the end of the day, is the simple model how this works. And like I said, we applied that in the education and workforce development arena, the environmental and infrastructure sector, and the health sector. All right, with a broad overview of how the model works, let's jump into the next slide if we could, and we'll start to get deep on the DC Water project. The DC Water project came about, and we're going to talk about sewers here, so hang in there with me. I'll get the broad architect of the background that made this transaction viable out pretty quickly here, but we're going to talk about sewers. Washington, D.C. has what's called a combined sewer system. There are 755 communities around the United States with combined sewer systems. A combined sewer system means that two things flow through the sewer pipe. You've got, we flush the toilet, the water goes down the sink drain, it's all going to the sewer pipe, and it goes to the wastewater treatment facility where it is scrubbed, and then it is sent out into the Potomac River and the Anacostia River. The other thing that's going through that pipe, and thus the word combined sewer, is stormwater. So when it rains and it hits the roof and then the gutter and then to the sewer, it's now in the pipe with our waste, and it's going to the same place. It gets cleaned and scrubbed and slowly discharged once it's cleaned into the waterways. The problem with a combined sewer system is it can handle an unbelievable amount of water through that pipe, but when it rains more than 1.2 inches in a 48-hour period, and it hits that peak flow, the mere diameter of the sewer can't handle it. So there's only two choices. It could back up into our houses and homes, which would be a fairly unattractive proposition. So it doesn't do that. So by design, when it rains more than 1.2 inches in a 48-hour period in DC, which is happening with increased frequency as a result of climate change, the waste, the stormwater and the waste that's running through the sewer, when it hits that peak volume, bypasses the treatment facility and goes directly into the Potomac River. Yes, and you heard me right. It goes directly into the Potomac River, which is why, by the way, it's illegal to swim in or touch the Potomac River. So that's been going on for 150 years. Nobody's built a combined sewer system for 130 years. It's a flawed architecture from the Army Corps of Engineers, who didn't quite predict climate change nor increase populations in urban centers. So along came the EPA about 10 years ago and slapped a consent decree on Washington, D.C. and a whole bunch of other major cities around the United States who have combined sewer systems and said, you got to fix it. So Washington, D.C.'s fix, our solution, was a $3 billion capital project to build 3 enormous gray infrastructure tunnels under the city. I won't bore you with why that will work, but it would solve, very, very comfortably and very confidently, it would solve about 94% of the problem that we just described. So over the past 10 years, 2 things happened. Number one, DC Water and Sewer Authority built one of those $1 billion tunnels. So 3 tunnels, $3 billion, so $1 billion a tunnel. They built one of those tunnels, by the way, on time and on budget, like go government, go. And the other thing that happened during that 10-year period was that the evidence that undergirds an alternative to building perhaps that 3rd tunnel started to mature. So, and that field was green infrastructure. So whereby 10 years ago, that was an idea that was a new idea. Flash forward 10 years to today, it's a very prolific solution that's got a lot of evidence to undergird that, maybe if we were to do hundreds of acres of green infrastructure across Washington, D.C., we could actually prevent the need to actually have to build that 3rd tunnel. What's the green infrastructure doing? At the end of the day, it's just serving as a sponge. And so when we ask the question, how much green infrastructure would you have to build in order to prevent the need for that 3rd tunnel, the answer was about 350 acres. And so if you have 350 acres of green infrastructure, so when it rains and we're having one of those big storms, you've got a big sponge. All it's doing is holding that precipitation for a day or 2 or 3 and slowly trickling it into the sewer so it doesn't hit that peak volume to trigger that bypass of the treatment facility. All right, so with that as the backdrop, DC Water had a big appetite to move forward with green infrastructure. Not only is it cheaper, but it has a whole lot of positive health externalities, environmental externalities, and job and the job from a maintenance perspective, because it's an above ground asset that needs to be maintained in perpetuity. It had an enormous job element, a sustainable job element that was very attractive to the leadership in the city. So they wanted to move forward, but DC Water found itself in that very common position where, as stewards of public funds, they're now facing that solution, that decision where they have 2 choices. They have business as usual, i.e. the gray infrastructure $1 billion tunnel that they know will work. And then option number 2, let's call it innovation, green infrastructure, which it'll probably work. Right? And as we all know in the public sector, that business as usual tends to win that argument more often than not. All we did with the pay for success model is create, by bringing in that impact investment to actually pay for the intervention and shoulder some of that financial risk, we just made it a rational decision for the DC government to move to actually choose the innovation, in this case, green infrastructure, to solve the problem that they were on the hook to have to solve. With that as the backdrop, let's get into what the actual project looked like here. And on the bottom row, where the core project work, it was essentially about a 5-year project. When we ultimately figured out what was going to be the metric that we can finance around, because the outcome was a cleaner Potomac River, there was a good proxy for that outcome metric, which was volumetric flow in the sewer, where there was great evidence, and the EPA agreed and scientists agreed, all humans agreed that if you were able to move the needle on that metric, you would end up with a cleaner Potomac River, which was the outcome. So therefore, we just financed around the proxy for that outcome as opposed to developed an elaborate evaluation scheme to actually measure the impact and control for all the other variables that are driving pollutants into the Potomac River. So once we found our metric, then we used year one to actually create the baseline by putting the flow meters into the sewers. So now that the flow meters are in the sewers, for 1 year, they're collecting the baseline data. And then once we have the baseline data, then we'll have 3 years to actually implement the green infrastructure. And then at the end of that 3-year period, in year 5, we'll put the flow meters back into the sewers to actually figure out how well the green infrastructure performed. Because we had a hydraulic model and we had the ability to run some Monte Carlo simulations out of that statistical model and develop some confidence intervals around that metric, the volumetric flow, we created 3 outcome buckets. One that were essentially associated with the normal curve, right? So if you had that middle part of the normal curve, that was as expected, right? So we had science that said that's how much volume we think we're going to control in the sewer. And then to the right, the tail on the right was the outperform. And then to the left, that tail was the underperform. So those were the 3 buckets of performance that we will only know the answer to at the end of year 5. All right, so once we had that whole project structured and the outcomes buckets aligned with the 3 areas of the normal curve, and we had our confidence intervals set, then what we did from the financing perspective is we just assigned an interest rate to each one of those areas of the normal curve, right? Or each one of those outcome buckets. So that middle bucket, as expected, we assigned an interest rate of about 3.4%. And then the outperform, the right tail, we said, let's have that be 6.6%. And then the underperform tail was 0%. And then because we wanted this to behave exactly like a municipal bond, because it was a municipal bond, then so we have the $25 million investment in buying the bonds. We had a normal coupon rate, and that normal coupon rate was tied to that middle as expected interest rate of 3.43%. So the bond holder is now getting a normal coupon payment against that 3.43 interest rate. And so that will go on for 5 years. And then at the end of 5 years, when we open up the magic box and we say, how well did the green infrastructure perform? Let's say it falls in that as expected box, because that's where we expect it to be. Well, it turns out that interest rate associated with that performance bucket is 3.43%. We've been paying you out at 3.43% over the course of 5 years. So just like a normal bond, we will repay the principal at the end of 5 years, and then we're all square. Similarly, let's say it lands in that top bucket of outperform. Remember that interest rate was 6.6%, but we've been paying you out at 3.43%. So had we had a crystal ball at the beginning of the project, we would have been paying you out at 6.6%, but we now know that we should have been doing that. So at the time of principal repayment, we will just tack on a success payment of the delta between 6.6% and 3.43%. And then similarly on the downside, if it turns out green infrastructure falls in the lower tail of the underperformance, then that interest rate is 0%. We've been paying you out at 3.43%. So at the time of principal repayment, we'll merely claw back the delta between the 3.43% and the 0% that we should have been paying you. There's one more piece of this project that I think is important to put out, or just to explain, because it'll make when this story gets told without this piece, it tends to create some lingering questions. Remember at the beginning I was saying they have to do 350 acres of green infrastructure in order to prevent the need to do the third tunnel? We only financed about 20 acres associated with this project with the 25 million. And the reason we did that is at $1 million an acre, it's really important for them to know how many acres they actually need. And so instead of financing all 350 acres at $350 million and do this project this way, what we ended up is just financing this project as a pilot, so that at the end of this project, they will know definitively how well green infrastructure performs. That 350 acre target number is currently coming from a software program, meaning they have a pretty good predictive model. That said, they don't have a lot of green infrastructure in the ground, and everything about the performance of green infrastructure is 100% driven by local conditions, soil composition and gradation and climate. And so at the end of this project, let's say, for example, green infrastructure, the performance falls in that middle bucket, then they can move ahead with confidence and pay for this green infrastructure by their normal municipal bond process and build the rest of the 350 million acres because they know they have the target right. However, if it lands in that top bucket where the 6.6% interest rate, they will gladly pay that $3.3 million premium to actually have found out how well green infrastructure performs. Because let's just say, for simple math, if green infrastructure performs twice as good as the software models predict, that means that they only have to produce half of the 350 acres of green infrastructure that they thought that they had to produce. They actually save about 175 million. And then similarly on the downside, if it turns out that green infrastructure, let's just say it just totally doesn't work, and so they will have now shared that financial burden with the investor, unlike a normal municipal bond. And now they know green infrastructure doesn't work in Washington, D.C., and they can progress forward with that third tunnel armed with that information, and they won't have blown their full $350 million on green infrastructure. So that is the DC Water transaction. I wanted to kind of get that out, and I think that usually sparks some questions that we'll be able to go into.
Great. Well, thank you so much for that overview, Eric. We will be taking everybody's questions over the course of the webinar. As a reminder, there's a Q&A button at the bottom of your screen. Feel free to enter questions throughout the webinar. We'll collect those and certainly direct them to Eric during the Q&A section at the end. For those of you just joining, Eric Letsinger of Quantified Ventures has just given us a fantastic explanation of how environmental impact bonds work, and then illustrated that model in depth with the example of the DC Water bond that his firm structured. Next, Eric will share lessons, specific lessons that he learned from that experience, and then move on to discuss some new environmental use cases that Quantified Ventures is focusing on for future environmental impact bonds. Thanks, Eric.
Thank you, Corey. All right, let's talk about some of the lessons learned. So one of the things I think we learned severely is you really need a transaction mindset to get these things done. These deals can become PhD studies if you let them. There were a handful of very decisive and clear moments when we had to figure out whether we were going to finance around the outcome of the cleaner Potomac River or whether we're going to finance around the proxy for that outcome, around something that we knew we could get into a fairly simple statistical model that helped keep this transaction simple at every turn at later decisions. But you really just need to, be waking up every day thinking about what can I do to make this transaction simpler, not more complicated every day, in order to get these things done. And then we talked about financing around proxies for outcomes. We're big fans of that, and it doesn't always work, but when possible, spend the extra time to kind of find that proxy for the outcome and then just discount the cash flows later. And then, the other thing, this project was oversubscribed from a investor standpoint. As soon as we sent out the term sheets, there was great demand for this project. All to say, it's our hypothesis that we do not have a capital problem. We just have a shortage of transactions problem. Keeping it simple and focusing on replicability. Like I said, we pick the use cases that, remember I was saying there's 755 communities around the United States with combined sewer systems. Many of whom are contemplating green infrastructure. All to say that creates a nice runway to actually, do the mind-numbing brain damage work on the first one and the second one and the third one and the fourth one, but to actually create a marketplace where we're actually ticking through that 755 set of counties and towns and cities around the country who have this problem. All to say, we focus heavily on transactions with great hope for replicability. And then the financing, working backwards from the structures that are normal to the capital markets. Like I said, this was the first social impact bond that was actually a bond. So we started with a bond structure as opposed to starting with what we thought made sense. So if you start with a municipal bond, start adding simple layers on top of it, as opposed to working towards something, you'll end up creating a financial structure that's more recognizable to the capital markets, which is the goal. Predicting performance, statistical models work well. Again, because we were dealing with something that lends itself to hydraulic modeling. Once you're in a world that you can get into a statistical model, you're on a downhill slide. And then evaluation, the evaluation rigor bar. This is something we talk a lot about at Quantified Ventures. Designing your evaluation model, we need a lot of support from academia and research. But the other thing, just to keep in mind, the goal, the bar that we have to get over in terms of evaluation is the due diligence bar from the investor. And I'm not saying that's a low bar, but that's not the same bar as a academic peer-to-peer review in academia. Those are two different bars. And so if our goal is to move capital to what works to get more outcomes, which that's our goal at Quantified Ventures, then we just shoot for that bar, the due diligence bar from the investor, and don't make it more difficult for us to satisfy the full field of academia. And then using existing structures when feasible. I think we broke every single rule with pay for success on this transaction, in the sense that, we had a lot of contracts that were let by DC Water, and we leveraged their procurement engine to actually select the service provider. The actual intermediary was DC Water. And some of those details may not make sense, but it's using existing structures to keep the transaction structure costs down. Amongst your deal team, you've got assets, you've got attorneys that can be leveraged. Use all that stuff as opposed to creating new structures and creating more fees for consultants. And then empathize with your cross-discipline and cross-sector partners. What I enjoy about doing these is these are multi-party transactions, usually with partners who don't occupy the same conference rooms on a daily basis, meaning you've got nonprofit players, you've got investors, you've got evaluators, you've got public sector leaders, you've got politicians, you've got engineers. You've got a whole bunch of humans who don't speak the same language, and empathizing with the boundaries that they operate in every day requires listening hard and understanding and respecting those boundaries as opposed to wishing them away. And then lastly, I would say these are not for the faint of heart, but they're not rocket science either. And I think at every turn with this DC Water transaction, we were fortunate enough to be working with a client who was thoughtful and willing enough to, at every turn, keep an eye on, is this decision going to make it easier for this transaction to be replicated or harder? Is this this decision that we're going to be making, is it going to make this transaction close sooner or later? So an emphasis on keeping things simple, I think, got us through this one. And then just a lot of perseverance. Quite honestly, this deal died 7 times, meaning we all went home on a Friday, feeling like that was the end of the project. And invariably, somebody on a Sunday would email somebody else around and say, hey, listen, what if we did it this way? What if we flipped it on its head and went completely backwards? And suddenly the deal's back alive. So there's a lot of perseverance required. Move on to the next slide. All right. So one of the things I just want to talk about this briefly. Just how do we think about so now that we have this DC Water green infrastructure transaction underway, and we've got a whole bunch of transactions underway where we're replicating that. The real we get this question a lot. What's a good fit for the model? And then, so here's a few thoughts. Is there a new environmental intervention perceived as risky that needs to be piloted? Or is there a proven intervention that needs to be scaled? We think this model can be used for either one, meaning a net new idea with a little bit of evidence, or that's ready to get out of the gates, or something that's got a lot of evidence that's ready to be scaled either within that existing geographic footprint or in new geographies. We think the model can be useful in either one. Do stakeholders have aligned interests but need incentives to work together? Most of our service providers have never worked with our payers. And even though they're operating in the same town and in general, in theory, have some alignment around generating similar outcomes. This is one that we struggle with a lot. Is an environmental impact bond the easiest, cheapest way to finance this project? Like I said before, these are not for the faint of heart, in the sense that we haven't gotten to the point where these are easy. And we look forward to getting to that day, to the point where we can transact these things efficiently, but we're all very new at these. So before we launch in, we make sure that there's not a better, cheaper, faster way of getting the transaction done. Is it large enough? The transaction costs are not low as a result of what I was just talking about, just because we're dealing with a lot of first of a kinds. So because of the transaction costs associated with these, we think there's generally a floor of about $2 to $3 million for scaling a project using this model. And if you're using the bond issuance model, I would say you're in the 5 million range for that floor. And then, are at least some of the stakeholders driven by regulatory requirements related to the environmental issue at hand? I wouldn't say this is a requirement, but to be clear, DC Water was under a consent decree, so there was a driver. They needed to move, and this became a financing mechanism to help them move, as opposed to a financing mechanism to make them do something that they were already not on a path to do. So we look for those kind of elements. We will move to the next slide there. And then just really quickly, it's been interesting. So we had some great partners surface when this closed, and the Rockefeller Foundation stood up, and the Kresge Foundation reached out, and the Chesapeake Bay Foundation, and said, listen, like the model, like that you got that done without any subsidies, like that you're building these things in a market-driven kind of way, like that you're angling your financial structures towards the broader capital markets. How can we help you move this transaction from being an N of one, viewed as a weird thing, to a normal thing where there's an actual market with a whole lot of quantified ventures out there doing this kind of work? And so they provided funding. Some of these funders provided funding to focus on different regions around the country. The Kresge Foundation, the Chesapeake Bay Foundation provided funding and support to actually scale this and replicate this transaction a handful of times across the Chesapeake watershed. And then the Rockefeller Foundation is working, helped us fund some transactions to deploy green infrastructure in their across their 100 resilient city targets. So that's an exciting progression. So we have a whole bunch of replication projects as a result of the generosity of these partners. All right. Really quickly, so when remember I showed that slide at the beginning when we were talking about some of the partners the NGOs who are working in this space and have been advancing their missions, their environmental and infrastructure missions through policy and through legislation and other means, and have recently turned to finance as a vehicle to advance their missions. We've been working with a lot of them to develop good, solid theories of change of how we could use this environmental impact bond model to advance other use cases. And these are some of them. I won't list them here, but there's a lot of them that fit well into this environmental impact bond model. And I would say, barring a couple of these, we have active transactions now underway across most of these use cases. And that's very exciting. Now, all right, so how about this? Let's go to the next slide, and we'll take a few of these and go a little deeper into how we are using the environmental impact bond to advance other issues. On the urban wood reclamation project, so the U.S. Forest Service came to us and said, how can we use this model to advance some of their missions? And it was interesting in some of the early conversations with them, there was a throwaway line in that conversation where they were talking about how more wood gets thrown away into our landfills across the country than actually gets deforested. And that was sort of a mind-blowing concept for us. And so when we got under the hood of where that's coming from, it's basically a lot of that wood that's finding its way into the landfills are as a result of demolishing vacant and abandoned properties, and all that wood just gets tossed into trucks and tossed off to into the landfill. And there was a program in Baltimore that had done some early pilot work called Humana. They're just tremendous. And Baltimore, with 16,000 vacant and abandoned properties throughout the city, a major blight concern. Obviously, there's a lot of crime that happens there. And a lot of cost goes into keeping them boarded and secured and cleaned. They started to pilot a program where they trained people who were just coming out of prison to actually deconstruct these vacant and abandoned properties, as opposed to just knocking them all down and throwing the materials in the truck and taking it to the landfill. They hand deconstruct the properties, and they put the materials in 16 different piles, and then they aggregate them in a construction site into 16 enormous piles of specific materials, and then they have a sourcing engine that sells those materials at the highest price point that can be gleaned globally. And some of those materials, some of those woods, turns out are actually quite valuable, and by creating that mechanism to sort and stack and distribute and sell those kind of wood to some higher price points, you've now turned a cost center into a revenue generating center that's actually training and employing hard to employ humans. So we've taken this whole program and built the whole economic model, and we're advancing down the path of structuring an environmental impact bond to address that. One of the things that feels really exciting about this transaction, and the reason we're talking openly about it now, is it seems it's going well and we think it will close. There's obviously a lot of cities with the exact same problem in terms of facing very expensive and costly and time-consuming demolition costs to get rid of blight. Detroit comes to mind. All right, let's talk about use case number 2. Agricultural best management practices. Here's the quick cartoon story on that. So think about the Lancaster Water Authority, who has to buy a $1 billion machine to address the new nitrate and phosphorus runoff from 320 upstream farms. And clearly the Lancaster Water Authority would rather not buy that $1 billion machine to handle that those nutrients, to buy that machine, and they would prefer that the farmers just implement the practices that would prevent that nutrient load from coming downstream. but they don't have jurisdictional authority to be able to play up there. So then the question became, why aren't the farmers doing these 5 evidence-based best management practices that have some evidence that said if they were to do them, that would probably solve the problem? And then is this starting to smell like the green infrastructure project, right? And so then when we look at, so why aren't they doing that? Is because they operate razor thin margin family farms, and they're not looking for added cost that's not directly driving yield on their farm. So then the question became, who has brand permission to walk up the driveway to those 320 upstream farms to deliver the capital to say, hey, farmer number 1, we'd like for you with this money to implement these 5 best management practices. Here's the cash to actually that'll cover your costs, and here's some cash to incentivize you to do so. And then when we model that out across 320 farms, and then, by the way, the answer to that, who had brand permission, that was Land O'Lakes. Land O'Lakes, as the largest dairy cooperative in the region, has that relationship with that farmer. So they became the service provider. So now you have a payer as the Lancaster Water Authority. You've got a service provider with Land O'Lakes, and then we're in the process of sort of modeling all that out. If everything comes up positive from a cost standpoint, then the investor will then pay the Land O'Lakes to actually incentivize the farmers to implement these 5 best management practices, and then we will measure the reduction of the nutrient load, the nitrate and phosphorus runoff to the downstream water authority. If that reduction happens to the level that we predicted well, then Lancaster Water Authority does not have to buy that $1 billion machine. Out of those savings, they will then pay back the investor. All right, so and then let's go to, really quickly, let's do this last one, and then we'll jump to some questions and answers here. We are using the same model to explore whether we can implement to address coastal restoration by investing in the development of new wetlands along the Louisiana coastline to help slow down the erosion of Louisiana's coastline, which is happening very, very rapidly. So that's a project that we're thrilled to be working with EDF and NatureVest and the Louisiana Coastal Protection and Restoration Authority. And by the way, that's the authority that manages the coastal restoration plan for Louisiana, and then they're also the entity that governs the BP oil spill money. So our interests there are all aligned to see how to leverage some of that new investment money to bring some of that BP money forward. Louisiana doesn't get all that money on day one, but meanwhile, they're losing coastline at a rapid pace every day. So how can we use this model to bring all those interests aligned? And what we're looking for, we're exploring, is the benefits to for-profit players down there, like the shipping industry, to be contributing as to either serve as the payer or to be part of a conglomerate of payers. So with that, I will stop, and then maybe we can use the balance of the time, Corey, to engage in a discussion.
Yeah, that sounds great. Thank you so much for this overview, Eric, and I won't take up any time because I want to dive into, we have an incredible number of questions, so thanks to all of our viewers for engaging and submitting. And I'll just jump right into them. Eric, we've had a few questions about the new bondholders kind of mentioned on the DC Water bond slide that you shared. People are just curious about clarifying the timeline. You mentioned the tenure of the bond is 30 years, but it sounded like there's principal paid back in 5, and there's sort of these new bondholders listed on that slide. Could you just explain sort of how that 5 versus 30-year breakdown works? Absolutely.
It was a 30-year bond. By the way, it was a 30-year tax-exempt bond with a 5-year put, meaning ownership has to change. Whoever buys the bond in year 1 has to give up ownership of that bond in year 5. The reason it's a 30-year bond has to do with more of the details of DC Water's existing bond covenants. So this needed to be a 30-year bond. But the two bond holders, the Calvert Foundation and Goldman Sachs, actually just bought the bonds to hold them for 5 years. At the end of 5 years, this 30-year bond will continue on as a normal municipal bond and will get repriced at the end of year 5.
Got it. Thank you. That's actually really interesting. Great. We'll move on to another DC bond question. We're just going to try to go rapid fire through this Q&A session to get as many of these viewer questions out as possible. Another question about the DC water bond. You mentioned that the environmental impact bond was maybe about 35% cheaper than issuing a vanilla bond. Can you explain a little bit and expand on that? What allowed you to achieve that? And is it a replicable strategy to attract more utilities to do such sustainable projects?
Yeah, I would say the lion's share of that 35% delta came from we didn't need to take this transaction to the rating agencies. That's probably the shortest answer.
Huh.
And again, because with a normal the plain vanilla municipal bond, the entity that's buying the bond is betting 100% on the credit worthiness of the issuer, in this case DC Water. And so that rating agency current rating is of significant value. However, the bondholder here with an environmental impact bond, what they're betting on is the performance of green infrastructure. So given that credit worthiness isn't the only thing that they're betting on, their need for a super current rating from Standard & Poor's, Moody's, or Fitch was not of value to the investor. So we did not incur that cost.
Great. That is very interesting. Thank you. One more. Well, there's a lot on the DC Water project because we got so much detail on that. But you mentioned finding the metric to sort of evaluate the underperformance bucket, the as expected bucket, et cetera. You talked about sort of the science and research that went into that. And we had a viewer who was asking about sort of how much that process cost, whether that cost was built into the cost of the bond or whether that was something sort of absorbed by Quantified Ventures as part of the transaction, who kind of paid to go into the sewers and take those measurements and make sure that, check what effect the green infrastructure was having.
Yeah. So there's two parts of the cost. On the cost of designing the evaluation model, which includes figuring out what metric we're going to finance around and how we measure that and all the statistical model we were talking about, that is part of the evaluation design work that gets that is what we would consider part of the transaction cost, to actually pull the transaction together. And then all the costs associated with implementing that evaluation model, for example, putting the flow meters into the sewer, maintaining them during the year that we're collecting that baseline, going back in year 5, all of that cost is basically paid for out of the investment. Great,
thank you. Another question about or a new question about environmental impact bond model, sort of writ large. How does that model change in the absence of a regulatory driver? In the DC Water case, of course, you have the government looking to do something. In the agricultural case, you discussed, the government is sort of facing these big costs of having to meet regulations. How does the EIB model change when you don't have that regulatory driver?
Yeah, it's a really good question. I take the Humanum example. There's not a regulatory driver there. There is, that's the urban wood reclamation project. There's just 16,000 vacant and abandoned properties in the city of Baltimore that are a black eye for the state and a black eye for the city. That all parties want that gone. It's not a regulatory driver that's looking for that. It's actually just a cost. It's very expensive to demolish those properties, and it's very time consuming. So having creating a mechanism like this that turns that into a more scalable model as opposed to just an extraordinarily expensive model, and bringing in private capital to move that needle faster is attractive. So there's an example of where regulation isn't driving it. But I will, it is a real regulation tends to drive more of these transactions than not.
Great, that makes sense. Thanks, Eric. Well, with 3 minutes to go until the top of the hour, we're just going to do one more quick question, and then we'll wrap up. We've had a number of questions, I think, inspired by the slide you had, where you sort of listed out all of the new environmental use cases that you're looking into. People are interested in learning more about those. People specifically ask questions about the coral reefs and anyway, a number of the projects you've mentioned. Where can people learn more about these? Is that at the Quantified Ventures website? Do you have any other resources you can direct people to? People are very curious about how this model is being applied to all the different use cases you've touched on today.
Yeah, absolutely. And listen, we do these type of webinars to engage with you, you all. So reach out to us and engage. We are, the fun part about what the work that we do is we don't at all pretend to have it all figured out. We need a lot of partners. We need a lot of smart people, and we need a lot of people who are willing to lean into this model to see what kind of damage we can do with it. So on the last slide there's a handful of ways to get connected with Quantified Ventures, and please reach out to us, and we'd love to begin a conversation with you.
Well, thank you, Eric. We've loved having you on today and have learned a lot, and it's great to hear that you're excited. Quantified Ventures is excited to keep engaging people and bringing people in, and we are glad that this conversation can continue. Unfortunately, we have run out of time. Thanks again to all of our listeners who submitted a huge number of questions today. That's been great for engagement. So we'd like to offer a big thanks to you, Eric, again, of Quantified Ventures, for a wonderful discussion today. The recording of this webinar will be available on our YouTube and iTunes channels, so please check back for those later. Also, be sure to check out the CBay website and newsletter for more information on upcoming webinars that we'll have this fall and next spring. So until next time, and on behalf of my co-host, Amy Torjay, who was covering everything behind the scenes today, this is Corey Scult from the Yale Center for Business and the Environment. Thanks for joining, and have a great day.